up.
Good afternoon. I'm with Phil Atwan. He's a resident tax expert, and I've asked him to come in and tell us kind of what's going on, what's new in the tax world as it pertains to apartment owners. So, Phil, thanks for coming in today.
Jim, it's a pleasure to be here.
What is new with respect to the IRS, Franchise Tax Board? Anything going on that we need to know about?
A couple things. Number one, they're talking with each other a lot more with all the new software that's been brought in. In fact, that's expected to grow even more so. So we're kind of concerned about
That's
that.
not good.
No, the other thing, I don't know if you know about this, but there's a new law that went into effect in 2014 that says that if you exchange out of the state of California, you have to now file a form each year with the state to tell them that you still have the property. If you've disposed of that property, the state gets to claw back the tax that's owed to them.
So it's like that one that we do at the end of a closing, but now you have to do it every year.
And absolutely, every year has to be filed, and if you don't file it, the state will consider the property as sold, and they want to be paid.
Well, that's good to know.
Yeah.
Okay, so that's the change where the state government and the federal government are talking to each other more with the advanced software. What else is going on? What are you seeing? I'm seeing a lack of inventory. What are your clients doing in that respect?
That's a huge, huge problem. What we're doing in terms of a lack of inventory, we found that in our legal department, the reverse exchange growth has gone up exponentially. More and more investors now are waiting to buy the right property after they find it and then sell. They know they can sell in a market like this. They just can't find what they're looking for.
So for those of you that aren't familiar with it, a typical 1031 tax deferred exchange, you sell your property, you have 45 days to identify, 180 days to then close it. That's a traditional tax deferred exchange.
Right.
A reverse exchange is you go ahead and sell your property,
Yeah.
close escrow, leave the money in an accommodator,
Right.
then you go find something.
On a typical sale, keep the money with the accommodator, and then close within 180 days with, like you said, the 45 days to name. But they can't find anything in 45 days, and that's been a real issue. The reverse exchange allows them to wait until they find the right property, whether opportunity knocks on the door or they've been actively seeking and then find the right property.
So if you're watching this, you never heard this before, how do they get a hold of you? You can explain a reverse exchange to them?
Yeah, real simply, you have to have funds to go into an acquisition, whether you get a swing loan, a bridge loan, a line of credit, whatever, your own personal cash. But you have to be able to acquire first. We have to take title to that property. From the time we take title to that property, you have 180 days to close what you're selling.
How do they get a hold of you?